All eyes are on the Federal Reserve's upcoming October meeting, and this one could be a big deal. Just last week, Federal Chair Jerome Powell sounded surprisingly dovish, hinting the Fed might be close to wrapping up its tightening cycle and opening the door to future rate cuts. So what does this mean for mortgage rates, buyers, and the real estate market heading into the end of the year? In today's episode, we're breaking down what to expect from the Fed, how their decision could move rates, and what it all means if you're buying, selling, or investing right now. Because the Fed makes a move, its effects can certainly ripple through the housing market. Welcome back to the Locked In podcast, where we make sense of what's happening with mortgage rates, housing, and the economy. Hey, Nate, how you doing?
Doing pretty good. How are you, Joe?
Good. It's good to be back in the saddle.
Yeah, absolutely. Yet another Fed meeting, and we have another episode of Locked In Mortgage Podcast.
Yeah, I'm really excited. You know, these Fed meetings it's been a big deal. There's been a lot going on surrounding it, a lot of talk about it, and a lot of pressure on the Fed right now.
Yeah. Next one's coming up October 29th.
Yeah, the next meeting is probably a week after people are watching that. In the last week of October, coming to its crescendo on the Wednesday, the 29th. Yep, around 2 p.m. is when they announce the results.
Gotcha. Things are going to get spooky, huh?
Maybe, right? Right around Halloween.
Cool. So I got a few questions for you. So the first one, what are some of the key factors that the Fed is going to consider going into this meeting?
You know, this meeting is going to be really interesting because the government's shut down currently today, which means the Bureau of Labor Statistics, where the Fed gets a lot of its information for, is also shut down. And so the Fed's going to typically they look at unemployment. They have a dual mandate to make sure unemployment is in check and the inflation data is in check. So they have a 2% inflation target. But what makes this one interesting is that they're going to have to either go off old data or they're going to have to go off private data like ADP and other things like that.
So ADP is the private jobs, correct?
Correct. That's the private sectors. They have reports about jobs data.
So is there any surprises in the data that might shift their view?
Well, you know, right now the lack of data might shift their view, but you know they're going to look at unemployment and see where's unemployment. Is unemployment cooling? Is it rising? Are we having more unemployment or less unemployment? They're going to look at inflation. Is inflation going up? Is it going down? Is it staying the same? And if the inflation's going up, you know, that might change their outlook and what they say and what they do. But there's also, you know, the unemployment. If that's really going up, that might supersede the inflation data.
Gotcha. So are they looking at mostly, with the lack of data that's coming out from the government, are they looking elsewhere, like maybe global factors?
So they could be looking at the bigger macroeconomic picture. You know, even the wars that are going on, Ukraine, Middle East, potential conflicts with China and trade wars, tariffs, things like that, they could be looking at as well.
Gotcha. So how could the Fed's decision impact mortgage rates and the housing market?
Well, the Fed's decision doesn't directly impact mortgage rates. And it's funny, last time around, the last meeting, we saw that the Fed's decision, actually, after they made the decision, we saw, even though they dropped it 0.25%, mortgage rates went up right after they dropped it. So going into that meeting, all the data was out there. So the things that directly influence mortgage rates are the effect that the mortgage-backed securities market is going through. So if inflation is going up, you know, the same factors that would cause the Fed to lower the rates is causing, you know, the bond traders to buy the bonds, which in fact pushes the rates down. So that's, you know, by the time the Fed meeting has happened, the traders have already, you know, made their moves up into that Fed meeting. So rates are going to go down with the Fed's decision and the rates as well.
So how quickly do you think we'll see rates move after the decision?
You know, it's hard to say. Last time around, the rates actually went up after the Fed dropped their rates because the mortgage rates had already been baked in. They already baked in that the fact that they were going to drop. You know, everyone was anticipating a drop in the Fed rate. Right now, there's a 98% chance, according to the CME Fed Rate Watch tool, that the Fed's going to drop the rates, right? And that's already baked into the market. But what the problem this time around is a lot of the data can't be seen because the BLS, the Bureau of Labor and Statistics, has been shut down. So if there is a direct effect, it's going to be in a something unexpected the Fed does. But unexpected right now in this market probably is not going to happen. I don't think they're going to go outside the norm right now.
Yeah, so you mentioned there's a 98% chance that they cut in October.
Right.
Future looking, how does it look? How long are we entering a rate cutting cycle, or is this kind of just a one-off?
Interesting. In the intro, I talked about how Federal Reserve Chair Powell, last week, he was in Philadelphia at a conference, and for the first time, he had been very dovish. For the last, year or 2 years, he's been saying it's data dependent. We have a dual mandate. We're looking at inflation. We're worried about tariffs. They're forward looking. They weren't necessarily data driven. They're looking at the tariffs. And, on Tuesday, really shocked the market because he had a full 180. He was being very dovish, which means he was being more towards, easing than versus tightening. And so in that meeting up in Philly, he talked about the ending of quantitative tightening. And quantitative tightening has affected mortgage rates more so than most things. And what quantitative tightening was, they were selling off securities from their balance sheet of mortgage-backed securities and treasuries. And they were buying or selling about $25 billion a month of each. Wow. And it's a lot, right? Yeah. $25 billion. Well, they slowed down the sale of the treasuries to about $5 billion, but they still had $25 billion a month of sales of the mortgage-backed securities, which artificially kept rates high.
Because the inverse relationship, right?
Because the inverse relationship between the price and the yield is the interest rate. So when you sell a bond, when you sell a bond, you're going to lower the price of that bond because you're selling it. You're creating supply. And if there's the same amount of demand and you put more supply out there, obviously that good is going to cost less. But when you have a lower price, it drives the yield or the interest rate up on that. So we've been keeping the mortgage rates artificially high for quite some time now. And, a lot of people are saying the housing market is being affected. We need to stop that. So by signaling that the ending of quantitative tightening, that's very bullish or very dovish as well on mortgage rates. It's saying that, look, we can end this artificial keeping of the rates high and rates can come back down. And that creates, allows more people to come into the housing market and buy homes because the pricing is going to be a little bit less due to the cost, not necessarily the price, but the cost due to the interest rate. Gotcha.
It's going to definitely help out with affordability. So quick question. How much does the Fed worry about market reactions to surprises?
Well, that's a great question because right now it's baked in the Fed's going to drop the rate a quarter, right?
Everyone knows.
Everyone knows what's going to happen to the Feds, which I always get worried when everyone knows something and something different happens, it's going to shock the market.
Pandemonium, yep.
Yeah, so if you shock the market, that could be very, very bad, even if it's a shock to the downside. Like if they say we're going to drop a half, well, markets weren't expecting a half, they're expecting a quarter. They're going to react one way. And if they say we're not going to drop at all, and the market was expecting a drop, that could be catastrophic for markets. Markets do not like surprises like that at all.
Gotcha. So does the politics kind of play a decision in these, or are they're supposed to be independent, correct?
For history, people have said, there's an independence between, there shouldn't be an influence of politics, but you can't deny people's own political opinions, and everyone has one. And there's two sides, right? So every president in history has tried to influence the Fed. Since the Fed's been alive since the early 1900s, every president has tried to influence the Fed. I don't care if you're Democrat or Republican, because the Fed controls the money supply to some degree. And that is powerful to your success as a president. So every single president will try to affect the money supply to make, the more money out there, the better off their presidency is going to look. So they've all tried to influence. Now, is the Fed influenceable? Absolutely, because they're people too, and they have political opinions. They have biases. They do. They shouldn't, but everyone does. So does it affect it? I think it plays a role.
Yeah, absolutely. It's definitely a tough job, one that I would not want under any circumstance. So how might the Fed's actions influence inflation going forward?
So the Fed has a dual mandate, like I said. It's inflation. They want to keep inflation in check, and it is unemployment, right? Employment. And they want to keep towards as close to full employment while keeping the inflation low as possible. I'm going to tell you there's an underlying third element that not a lot of people talk about, but I believe is a big effect, and that is low interest rates, right? The appetite for cheap money is huge. And we've proven when we go above on mortgage rates, when we go above like 6.5%, 7%, the market just dries up. When we, in the real world out there, debt is a major part of our lives. Everyone uses, not everyone, most people use debt to finance their life in one way, shape, or form. So when the debt goes up, our country comes to a halt. It could potentially cause recessions and these things. So I think there's a third unspoken mandate of low rates. Not to mention the bigger problem at play, which is that $9 trillion of debt our country has to refinance within the next year. And they want to refinance that at a lower rate versus a higher rate, just like everybody else wants to do, right? And so, I think it plays a very big role.
So what tools besides rate could they use to keep inflation at bay?
I think what's going to happen in the near future is that the 2% inflation, they're going to accept a higher rate of inflation. I just think that this country is so dependent on cheap money, more so than they are low inflation, which doesn't bode well for the average person, right? It doesn't bode well for the average person that doesn't own assets. Because if you keep cash, your cash is going to be worth less and less, while your assets are going to be worth more and more. So if you have no assets, you have no home, you have no gold, you have no crypto, you have no stocks, your money is going to be worth less. The old adage of you got to save money, well, that's a banker's term. You got to save money. The bankers made you think saving money is good, because what do? You save it in their bank. They give you pittance on return, and then they take that money and make double-digit returns while they pay you a pittance. Well, they need you to save money. The reality is that the assets are going to be worth more when there's inflation, and dollars are going to be worth less. So I'm not telling you to run out there and get rid of all your dollars, but make sure you're hedged with some assets, whether it's gold, silver, stocks, bonds, crypto, and my favorite, real estate, right? And who cares if you're borrowing money at 5% if your house is worth 10% more every year, right? Mm-hmm. But I mean, obviously this isn't financial advice. I'm not your financial advisor. But that being said, I think you get the picture is that right now I think our country is willing to accept more inflation, or are going to be forced to accept more inflation as we grow in order to have that cheap money.
Especially when you think about looking at the inflation numbers, and housing is one of the biggest buckets. So, if you lower rates, everyone floods back into the market. Inflation might show a little bit higher because home prices are increasingly going up as well. Is that the case?
Well, housing is a big part of that bucket of goods that's in inflation. And when we have higher rates, I mean, our housing costs are more. Mm-hmm. So we're creating inflation through higher rates in that regard. I mean, it's supposed to stem demand in other areas, but the housing paradox is that, the housing market is problematic with the higher rates, but you lower the rates, now it's problematic in a different direction. Yeah. You're gonna have more people in the market, which is going to drive housing prices higher.
Yeah, absolutely. So what should homebuyers and those looking to refinance as well be watching in the Fed statement?
A lot of people look for, did they raise the rate or not? Is it a quarter? Is it a half? Is it not at all? And you got to know that. That's what they do. Oh, they lowered it a quarter. Great. Now, it's what they say. It's the words they use after the meeting at 2 p.m., 2:30 when Powell speaks. And he'll talk about what they see looking forward. Do they see future rate cuts as possibility, a probability? They use some very specific language here. And, they only change a couple words every meeting. Mm-hmm. So are future rate cuts in the cards or not? Because this rate cut's already been baked in for the most part. We have another couple days for the market to bake it in. But by the time that Fed meets, they've already baked in a quarter point as far as the mortgage rates. And it's not a dollar for dollar or percent. Just because the Fed drops their rate by a quarter doesn't mean the mortgage rates are going down by a quarter. A lot of people don't understand that, but that is fact. And it does mean that your home equity lines of credit might go down, your car loans might go down, your credit cards might go down, prime rate is going down, your home equity, I already said home equity lines of credit, your second mortgage rates, student loan rates, those all might go down. But mortgages are independent of the Fed's decision.
Gotcha. And sometimes in those Fed meetings, they talk about dot plot. Can you explain briefly kind of what a dot plot is?
They don't do the dot plot every meeting, and the dot plot is when the governors on the Federal Reserve Board, the Federal Open Market Committee, it's where they see the rates going. They plot dots like this Fed chair says this month it's going to be there, where the future rates are going to be out. I think they look out 2 years or maybe more about where each individual governor thinks the rates are going to be.
Gotcha.
So that's very forward looking.
Forward looking. Gotcha. So could lower rates hurt some buyers despite lower borrowing costs?
Yes. The answer is yes. The lower rates could hurt some borrowers. Now, they might enjoy lower borrowing costs, but if home prices go up, if it brings more entrants more buyers into the market, and housing supply is still relatively low, considering how many people were looking for houses versus how many houses were for sale. There's a very low supply of homes. I think it's been said there's 4 million. We have a 4 million home shortage right now.
Wow.
And builders can't build fast enough. So, if the supply is low and the demand increases, well, that's going to push pricing higher. And if pricing goes higher, it's going to make it more unaffordable. So it's kind of that paradox I mentioned earlier, that if the rates are high, it hurts the housing market. If rates are low, it hurts affordability. Mm-hmm. And so, you might see affordability as far as the home prices go up and kind of negate the whole rate cut.
We talk about pent-up demand. There's so many people on the sidelines just waiting for rates to drop. Right. So once they see it on the news, they feel comfortable with the payments and such, they'll flood in back into the market, which we talk about all the time. How does the meeting fit into the larger economic outlook for next year?
Well, at the meeting, they're going to set the tone for the end of the year. So we have this October meeting. There's no meeting in November. Then there's a meeting again in December. And it's predicted they're going to cut by a quarter in October and a quarter in December. And then it takes a while for those rate cuts to really be felt. And so it's going to push into next year. So it's going to set the tone for 2026. And 2026, there's more rate cuts expected. And Federal Reserve Chair even mentioned quantitative tightening coming to an end. Well, next up after tightening is easing. That's the opposite of tightening, is where they buy the mortgage-backed securities. They create the largest purchaser of mortgage-backed securities that helps further drive down rates. Now, there's no indication that that's coming anytime specifically, but that could happen depending on the market, depending on inflation, depending on jobs, and depending on where rates are and the demand in the market. But I think next year will be more continued cuts. Rates might drop lower. I don't think they're going to pandemic levels. I don't think we're going to see 3s and 4s again. But you might see on some government loans, maybe with a point or two, you might be seeing some loans in the 4s, more loans in the 5s. 6s I think 5s and 6s might be the norm next year. Now that's a wild prediction. I can't tell you exactly what's going to happen. And here's the biggest thing. That we talk about rate cuts, we talk about what's anticipated to happen, we talked about it being baked in, but the reality is no one really knows. It only takes one black swan event to change the whole course of all these things. It only takes one small decision or large decision by our government or another government that is unpredictable right now to change all of this. And here's the lesson I want people to take away from everything I just said, is that no one knows what the future holds. Just because everyone says it's going to happen doesn't mean it's going to happen. It hasn't happened yet. We talked about lower rates last year and the year before. Hasn't happened. There's no telling when that's actually going to happen. So if you see a rate that might help you refinance your house and better your position, look strongly at it. Don't worry about what's in front of you, not what's potentially out there, because potential is one thing, reality is another. And if you're waiting to purchase a home, you will pay more if rates go down because more people come into the market. But if you buy now and rates do go down, then you could potentially refinance. We've talked about this ad nauseum, but people think it's some kind of sales technique. But I'm telling you what is reality, and the reality is no one knows what tomorrow holds.
What's that one adage? One in the hand is better than two in the bush.
Bird in the hand is better than two in the bush. That's saying, look, I got one right here, or I could go after those two that I don't know exist, right?
Yeah.
And I'm not much of a hunter, but I've heard these things.
Gotcha. A little bonus question, because I know you're into stocks and cryptos. How might the outlook affect other investments like stocks and cryptos?
Well, very easily put, it's called risk on. Now, if you're getting 5% in your savings account, which is FDIC insured, there's not a lot of motivation to go seek higher returns, right? You're going to keep money in cash, depending on inflation, but a lot of people are going to keep money in cash. If that savings rate goes down to 2%, 1%, there's a lot of incentive to go out and find higher risk assets like stocks stocks, equities, bonds, crypto to find a higher rate of return. They call it a risk-on environment. And if money is pumping, which we predict that it's going to pump into the economy either through cheaper money, printing, they said Fed prints money. The Fed lowers rates at which, the overnight rate at which banks borrow money to loosen the money supply. So more people borrow money because the cost to borrow is lower. And that's how they print money per se. They don't actually print money. That's the Treasury that prints the money. So if there's more risk on environment, people are going to seek higher returns. Then people are going to look at, like I said, stocks, bonds, equities, crypto. And that's where I'm saying, like, if you're not invested, you're going to get left behind if we go into that environment. Or you can keep it conservative and hold cash when your cash loses value every year.
Gotcha. Well, all really good stuff. That's the questions I had for the episode. If you're not, like, comment, subscribe, and please share with someone that may benefit from it as well.
Thanks for watching. We'll see you next time so we can help you get locked in.